What's up guys, I hope you're doing great, and today in this video I want to talk about the confluences that you can use with the supply and demand trading strategy in order to increase the winning probability of your trades. So before going to the confluences themselves, first we need to understand what does the confluence mean. And in order to do that, let's review the confluence definition. If we go over the definition, confluence is the combination of multiple strategies and ideas into one complete strategy. Confluence occurs when two or more separate ideas or strategies are used together to form a comprehensive investment strategy that is in line with the investor's risk profile and goals. So what this means is, let's say if you're trading on the basis of a single strategy, that strategy could be based on any analysis like RSI, MACD, candlestick patterns, or any analysis, but you're only taking into consideration one analysis. So let's say you're trading on the basis of RSI. Now, when you're trading with that, you will not be able to take a lot of good trades because RSI on itself does not work really well. So what you do is you take into the consideration the formation of candlestick patterns. So when you combine these two analyses, then the strategy that will come out will be much better than trading either candlestick patterns alone or the RSI alone. So this is how you combine multiple analysis and multiple strategies to form a single strategy. This was a very basic example. So here we can see a chart of few of the very good confluences that can be used along with each other or along with any analysis that you're doing. So first one is the Fibonacci tool, and second one is the candlestick patterns. So and then we have the support and resistance zones, the chart patterns, key levels, and supply and demand zones. So in this video, we are mainly going to be focusing on the supply and demand zones and key levels, or supply and demand zones and Fibonacci retracement tool. But in our upcoming videos, we will also be covering the candlestick patterns, the support and resistance, and chart patterns, and how you can use each of these along with the supply and demand zone. So as I said, that in this video we're going to be focusing on the supply and demand zones and these two confluences. Now another thing you have to keep in mind while you're trading with confluences is you should not add a lot of confluences. Like, let's say if I am adding a confluence of candlestick patterns, and then there's also confluence of RSI, and then there's also a confluence of support and resistance. So a lot of confluences combined together will decrease the chances of you taking good trades, because then you will not be able to find trades that are within your specific rules of the analysis that you define. So that's why you should also take into consideration that your number of confluences should not be more than one or maximum two for an analysis. Okay, so let's say if I'm trading with supply and demand zones, let me just go towards the chart, and let's say if I am trading on the basis of supply and demand zones. Okay, now as I said, we're going to be focusing on the Fibonacci retracement and the key levels. So in this scene here on the chart, we can see that there is this very big bullish move in the market from here to here. Okay, and within this bullish move there is the formation of this demand zone. Now when we take the Fibonacci retracement tool and draw the retracement for this bullish move, so the Fibonacci retracement tool, if you're not familiar, is a tool that is used to calculate the retracement levels for a big bullish moves. It could be either in the bullish direction or bearish direction. So let's say from here to here market moved very impulsively, and if I take the Fibonacci retracement tool and draw it from this low to this high, then it would give me a 61.8 level to which the market might retrace, and most of time it does follow that rule. So the zone between the 50% and 61.8% is the golden zone. And let me just take the Fibonacci retracement tool and start to draw from here to here. Okay, so here you can see that for this bullish move, when I draw the retracement, the level between 0.5 and 0.618, or 50% or 61.8%, is the golden zone. And within this zone there is the formation of the demand zone. Now what does demand zone say? Demand zone tells us that after the formation of demand zone there will be a lot of pending buy orders placed by the institutions, and market will come back in order to pick the pending orders and then move in the bullish direction. Okay. And what does the retracement say, or what does the Fibonacci retracement tool say? It says that after this big bullish move, the market will retrace back towards this golden zone, and after that, it will move in the upward direction. So now both these analyses are complementing each other, and this is very important. So when these analyses are combined and both of them are giving similar analysis or similar forecast, then the probability of our trades winning increases by a lot of folds. So now, as you can see, after the formation of this big impulsive move, the market did come back and it did pick the pending orders from this demand zone, and also it retraced only to this golden zone, and after that it started to move in the bullish direction, as you can see here. So this is the power of using confluences with the supply and demand. By the way, you can also use our supply and demand indicator in order to draw the supply and demand zones automatically for you on the charts. And for now, we also have a 30% off Christmas offer going on, which is valid till the end of December. So if you're interested, please check the links in the description. Now let's talk about the other confluence that you can use along with the supply and demand zones. And that other confluence is the formation of key levels. Now, key level is any level that is important for price action. And if we look at this key level, first of all, let's look at this bullish move, okay? And here we can see that within this bullish move, there is the formation of this rally, base rally demand zone. Now, with the formation of this demand zone, if we look in the past, we can see the formation of key levels, and there is this key level from which the market is being rejected multiple times, and also at this key level we can see that market got rejected a lot. So both these key levels are important because market is getting rejected from these key levels, and also at the same level in the market there is the formation of this demand zone. Now when these two analyses are combined, again we get an output analysis that says that after the formation of the supply zone, and after, because these are important key levels, the price will behave when it reaches these key levels. So when we see that at this close of this candle, the demand zone was complete, and within the next candle the price came down to pick the pending orders, and then it moved very impulsively in the bullish direction. So this is how you can combine multiple analyses in order to form a single analysis. I hope you were able to get the agenda of this video. If you have any questions, please comment down below. I would love to answer them. Also, don't forget to like, share, and subscribe. See you guys in the next video. Thank you.